Topic A this evening, resilience. We closed the week on an up note. The Dow closed up almost 62 points. Financials, materials, and technology, they all led the way. Wells Fargo and Citi, they were among the big financials there today. Intel, Micron, as well as AMD, were among the big tech stocks that rallied. The fear gauge, the VIX, dropped 10%. But hold up. Lesson learned, the Middle East could be a big problem. Oil is the wild card here, so much so that some are saying that if you thought the inflation storm clouds were coming, we might actually be seeing a stagflation storm heading our way. Let's ask our market weatherman to weigh in on this one. Here now is Jim LaCamp of Macro Portfolio Advisors, Lee Munson, Chief Investment Officer at Portfolio Asset Management, and David Dietze, President of Point View Financial Services. Good to see all you guys. Jim LaCamp, what do you think? Is oil going to derail this economy?
Well, it may not be just oil, Trish. There's a lot of things that could derail this economy. Forgetting oil for a moment, we have a tremendous amount of debt that rolls over in Europe over the next month. We have the Irish elections, the German elections, the U.S. debt ceiling. Now you add in on top of that oil prices that are set to escalate even further from here. And remembering that oil price spikes have preceded every economic downturn we've had since World War II, you have to be a little worried. So the prognosis is very, very cloudy, and we need to watch out for these storm clouds.
Okay, David Dietze, right here on set with me, is sitting here nodding his head in agreement, especially when you mentioned the oil prices and their correlation to previous recessions. Most economists will tell you a $10 per barrel increase in the price of oil is going to equate to at least a couple of tenths of a percentage point off of GDP. David Dietze, how does this how does this affect your investing right now?
I think you got to be cautious here because obviously the Middle East has proven to be a major catalyst for people to take stock of what's going on here. And what is going on here? We've seen stock prices double since March. We've seen it March 2009. We've seen the stocks go up about 30%. We've never had a year when the low point for the year occurred on the morning of the first day of the year, the first trading day. So obviously we are ripe for some sort of a correction, as sentiment has gotten very, very strong, and perhaps this Middle East contagion is the catalyst.
Lee Munson, would you take money off the table right here?
No, I mean, the only thing that I did, first of all, listen, I took some money off some trades in oil that I placed last week because I wanted to ring the cash register. I'm not taking any money off of the oil stuff. And I think that, Jim and David, I see their point, but, honestly, Libya, just because Europe has a problem because the refineries are so sensitive to the type of grade of oil. I mean, Jim knows right here in Texas, in America, we can take any, bad grade oil, petroleum, that's West Texas Intermediate, and we can make it into gas. We've got plenty of supply right here. I think everybody's so concerned about the price of Brent, which is sometimes fair, sometimes not. But look at the VIX.
Regardless of the technology or whether we can replace it or not, the prices are what they are. You can't argue with the trends. And forgetting about the Middle Eastern problems, we had a big rally in energy even before the Middle Eastern problems. In fact, if you look at what energy prices were doing between July and November, you had a very big run.
Hey guys,
I'll tell you what the big run is. The big run is me taking stock. I was let in on Monday and Tuesday where I could actually buy some broader markets, specifically the NASDAQ, and I hadn't been able to in a while. If you don't use these pullbacks and this fear, because that's what it was, and the inflation psychology.
It's not much of a pullback, though.
Yeah, the NASDAQ's doubled now, and
because we're in a bullish trend right now. It's going to be
enough to get in. Listen, guys.
Look, we've doubled since 2009. If you're calling this very much of a pullback, what are you going to do when the stocks drop 15%? You can't keep buying 2% pullbacks and have any money left.
Okay, David,
if you have a 15%.
I want to get David Dietze in real quick, and then I want to start talking about whether we're going to see inflation or stagflation. David Dietze.
Let's look forward, guys. I mean, the central question on investors' minds this weekend is this contagion in the Middle East going to spread? And the commodity you want to be looking at? You want to be looking at rice. Rice is up 50% since last summer. Half the world considers that its major staple, and up to half of all their spending is due to rice. Rice rebounded 3.4% today. What are other people around the world going to be thinking? My concern is that that's going to be a catalyst for further turmoil.
Well, Jim LaCamp, long before we saw what was happening in Libya, we saw that wheat prices were up triple digits. We saw corn prices up. You heard David talk about rice. Soybeans, for goodness sakes, they were up, and cotton's at a level that we haven't seen since the Civil War. So it's clear clear that inflation has been creeping into the global economy. With all that in mind, as an investor, is there any argument to be made that you want to be in equities right now because we're going to see more and more inflation?
Well, yeah, you do want to be in equities now for inflation, but you want to be in the right kinds of equities. A lot of equities are going to have margin pressure because of these rising prices, and you need to avoid those. You need to be in areas like the fertilizers. You need to look at the companies that dig up the stuff, Deere, Cummins, Caterpillar. You need to be in countries that aren't as affected, like Taiwan, that makes the semiconductors. So you need to be very, very selective now about what kind of investments that you're in.
Well, I agree. You want to be selective, but I'm looking for investments that haven't been picked over. They haven't doubled in the last year. I would recommend the healthcare area where you have some of the premier names in the sector yielding 4% or more. And those are the things where no matter if the economy does take a hiccup here because of these higher energy prices, people are still going to be spending and buying the drugs and healthcare services.
Hey, Lee Munson, what do you say to those who say that
socialized,
there's a good chance we could see stagflation on the horizon?
Yeah, I don't really see a lot of inflation right now in the developed economy. I hate how nobody wants to talk about the inflation in the emerging market being completely different at a different rate of change than we have here in the United States. And the response is always, well, it's going to increase here. Okay, they're heading in the same direction. But I'm not really concerned about taking money off of U.S. domestic equities. I haven't been in Europe for over a year, and I'm not planning on going back in there. I mean, we're along things in the ag sector. I like what Jim is talking about. I like that. I like the ags. But I still think you have to wait for a little bit of pullback. But I wouldn't have dead money, wasting away in
Okay, so what are you buying? What would you buy right now, given the environment?
Right now, given the environment, I would be long. I'd be long the Nasdaq because it's pulled back the most over the last week. I'd be long grain. We're long GRU. You can look at JJG. They're exchange traded notes that reflect the price in grain. And I'd say you want to trade USO. You want to trade oil right now. But I think you can be long some of the integrated oil players because I think they've got great earnings and they're less sensitive to the price of oil. Not a lot of investors look at the history books and see how the price of oil and the price of Exxon, their earnings, they don't correlate. So I'd be long energy, and the S&P, a major contributing factor to it, is energy right now.
Hey, you're not alone.
I'd stay out of Europe.
You're not alone piling into that commodity sector. But what I'm concerned about is what's the next step in terms of monetary policy? Are they going to continue providing us the punch bowl, or are they going to be taking it back?
It's
going to be QE3.
I think that's one of the big risks.
Absolutely, Trish.
That's one of the big risks.
Trish, QE3 is happening.
Interesting. Lee Munson, really, are we going to see QE3?
I think the Bernanke is crazy enough to do it, and I think that they're not concerned. They're detached from the American consumer. I'm not saying it's a bad thing. I'm not being judgmental. Bernanke doesn't call me to ask me my opinion, but I think they're going to feed this punch bowl because they're looking at the CPI. They're detached from the American consumer. They don't care about food and fuel. They're convinced from their economics classes that those things all wash out in the end. I think they're going to jack up the system with more stuff because we don't have a growth rate here in America like they do in China.
Jim LaCamp, if they actually do that, if we see QE3, it's going to further depreciate the U.S. dollar. Aren't they going to therefore contribute to even more inflation?
Look, bond yields have gone up since QE2. What they said was that QE2 was to bring rates down, and rates have gone up. If they talk about QE3 and they enact QE3, it's going to be a massive credibility problem for the U.S. dollar. It's going to push Treasury yields up even further. And you're talking about now a Fed that owns more bonds by July than Japan or China combined. And we're going to have a very serious currency problem.
All right,
come on, Jim.
We got to leave it there. Thank you so much for joining us on this Friday night. Appreciate it to all of you.
Thanks, Trish.